An important concept in the field of finance is being able to find I guess the best way of saying it is the true value of an asset. The other things that we're going to do in this book will be including some basic time value of money and managing risk, but the big part of this book is on valuation. So one of the most important concepts in chapter 1, the first chapter of our book, is always discussing intrinsic value, which is this average price over time. Now, the way I like to represent this is a picture that I'll use in some other lectures, but I'm just going to draw a line. I'll do the best I can with this line. It's going up, and I think most students would agree, or non-students would, if you buy an asset in the past, P be the price, and -1 would be 1 year past or one period past. And we'll make a second line here in a different color here. I want to put a straight line here just for right now. We'll call this the present. And I can call this P0 for P now. And then I'm going to go back and put my P1 here. So this would be an asset that I purchased 1 year ago. And today it's worth this much, and then 1 year from now I'd hope it'd be worth this much. Now let's look at how we determine intrinsic value. First of all, this present value, and I'm going to go ahead and call this line here, it's market price. Now the market price is what it would be sold for today on, we'll just go ahead and use the New York Stock Exchange. I could use the NASDAQ, whatever. The market has determined the value of this particular asset. We'll call it a stock. The influence of buying and selling is what drives the price up or down. For instance, if many traders decide to start purchasing a particular stock, the specialist on the floor will notice that his or her amount of stock, or the stock available to buy and sell, has started to dwindle. So supply and demand basically states that as the demand starts to diminish, the price will increase because there's a high demand on it. Kind of like you go to the grocery store and you want to buy some tomatoes and there's very few of them, the price might rise, will rise based on the demand. So the market, I guess the actions of buying and selling play with, will move this stock up and down. So I could call it, just to keep it simple, I can call it, if we're right here, we're at equilibrium price. That means the market has set the price at whatever it has set it at, and the true value is also at that price. Now, in this course, we're going to learn how to calculate the true value of any asset. It was given to us by the economist called the principle of asset valuation, and it basically states that we can determine the value of any assets if we know all these future benefits it would receive. And this is also a future benefit here because the value goes up. If we can determine all these future benefits and we find some rate of return that's commensurate with its risk, we take some basic calculations and discount them back, we can find out what this price right here is. Now, most of our analysts, they'll give you the math by which we do this, but they're not going to tell you how they make these numbers up. So, for instance, the great Warren Buffett or Marty Whitman, they'll do their due diligence as well. So let's say we do this and we determine the stock is worth $30 today right here. So I'll put a line. I'll just say $30. So that's what the market says it's worth, and that's what we have determined based on our analyzing of this particular stock that's worth $30. And let's just say for the fun of it, it's now worth $32 a year from now. So we did find a stock that did rise, and let's say that it paid dividends 4 times. And generally, stocks pay every quarter. There's 4 quarters in a dollar, and let's say that each quarter we received a 25-cent dividend. So we can determine what our return was with this stock by simply saying, well, I made percent-wise $1 here, because a quarter times 4 is $1, and I made $2 here, so I made a total of $3 on a $30 purchase. So if I made $3 on a $30 purchase, I made a 10% return. Now, you're going to find out in later chapters we tend to break these two parts up for stocks. So I'd say I made $1 on a $30 return and I'd made $2 on a $30 return. I've got to look at my dividends and I got to look at my capital gains. And we look at the two together and we say we have a dividend yield of about 3.3% and 6.7% here. But we'll worry about that in later chapters. This is where it gets fun. Some of the things we do early on is what some of the fundamental investors such as Warren Buffett do. What they do is, and I'll do a different color here, is when they determine the intrinsic value, and let's say they do their due diligence here and they say it's worth $30 and the market implies that it's worth $30, they wouldn't purchase. However, if they find a stock that's here, that means that it's undervalued. They determine that the value of the stock is this and they purchase it. They get this growth plus this growth. So in essence, they do a little bit better than the average investor. Or the great investors do not purchase any asset unless it's 10% undervalued based upon what the market thinks it's worth. And basically that's how we look at intrinsic value. We will do some of this math in this course, so I just want to make sure that we have a good understanding. Intrinsic value, once more, is the average price over time. It would be this price, and we use some basic math to determine this. Well, that's about it. I hope you have a wonderful quarter.